Every year, a handful of annual reports are issued to the Colombo Stock Exchange. They are not just compliance documents, but they are confessions. They tell you exactly what a company believes about its own future. This time, one of those reports is from a bank that just posted the highest profit in its 39-year history. I'm talking about none other than Sampath Bank PLC. Welcome to my podcast, and I'm your host. And today we are doing a full strategic teardown of one of Sri Lanka's largest private commercial banks, not just the numbers, but the thinking behind the numbers. Vision, competitive positioning, execution, culture, and finally, what it all means for your portfolio. Grab a coffee, let's get into it. Let's start where every strategy starts. Intent. Sampath's stated purpose is short. Empower dreams and enrich lives. And their vision talks about being the lead in transforming lives by unlocking financial potential through innovation, integrity, and empathy. Soft language for sure, but here's what makes it interesting. In 2025, they operationalized that vision into something called EvolveX, a refreshed 5-year strategy the board explicitly frames as a responsive system that adapts, evolves, and most importantly, delivers. And EvolveX is the slogan bolded on for the annual report. It has an actual origin story. The bank says the need for it was identified back in 2022 after an internal evaluation of its external environment, strengths, and weaknesses. Then they spent 2023 and 2024 formulating it, even bringing a global consultancy firm. Before the board formally approved it, and the new vision was unveiled. So, what we are looking at now in the 2025 report is year one of a planned 4-year execution window running through 2028. The strategy itself rests on 4 pillars: business, strengthening the core and expanding growth engines; technology, driving digital first banking; people, building the capacity and culture for growth; and sustainability, embedding AESG into the core. All 4 are explicitly built on to deliver. In the bank's own words, sustainable value to all stakeholders. So, vision sets direction. EvolveX is a mechanism, and it's now mid-flight. Let's look at the environment that mechanism has to operate in. Sri Lanka's macro backdrop in 2025 was, in the chairman's own words, one of heightened global uncertainty and a fragile but steady recovery. GDP grew an estimated 3.5%, inflation target, and the country IMF extended fund facility reach, all of which helped restore some investor confidence. But it wasn't a clean year. Cyclone Dipa caused real damage to infrastructure, energy, and irrigation systems, and the bank had to step in with moratoria and targeted relief for affected customers. Against that backdrop, here's a headline event of Sampath's year. In April 2025, the Central Bank of Sri Lanka designated Sampath the domestic systematically important bank, a DSIB. Only a handful of banks carry that label. It's simultaneously a badge of scale and regulatory tax. It comes with an extra capital buffer requirement layered on top of an already rising bar. Since the whole banking sector's capital adequacy ratio moved up to 18.6% by the third quarter of 2025. Internally, the resource base scaled fast to match. Total assets reached just under 2 trillion rupees, up 11.3%. Gross loans and advances grew 26.9% to 1.22 trillion rupees. That's not organic drift, that's deliberate acceleration. Competitively, Sampath sits in a crowded private commercial banking field, competing for CSA deposits, remittance flows, and increasingly customers who care more about app speed than branch count. Sampath's own current and saving ratio improved to 34.66%, which tells you deposit competitiveness is holding even as sector-wide interest rates ease and margins compress. So, strong balance sheet, real regulatory weight, operating in a recovering but fragile economy. That tension is exactly what shapes the next part of their strategy. Let's zoom into the business pillar specifically, because that's where the competitive strategy actually lives. Sampath's own language for it is accelerate revenue diversification and margin resilience by scaling fee income, depending customer primacy and maintaining prudent balance sheet discipline. Translation: don't compete on interest rates alone in a market where rates are falling anyway. Compete on relationships, product breadth, and fee generating services. Four sub strategies sit under that: deepening corporate relationships, where corporate loans growth ran 34% in 2025, scaling non interest income streams. Engaging the affluent and emerging wealth segments and building a distinctive SME franchise. That affluent segment push is genuinely interesting from a competitive strategy standpoint. Sampath launched Sri Lanka's first decentralized private banking model with 7 dedicated units, 4 of them placed outside Colombo. That's a first mover move into high net worth banking outside the capital, an underserved segment most competitors haven't bothered decentralizing into. Classic strategy terms, this is differentiation with the cost discipline undertone. They are not trying to outprice the market on savings rate, they are trying to out relationship it, powered underneath by the fifth, less visible layer, elevating data analytics into a core capability that feeds personalization, automation, and risk foresight across all four pillars at once. Let's get concrete. What did the bank actually do in 2025? Beyond the private banking rollout, they launched Sampath Select, an AI powered instant personal loan completed in 5 clicks inside the Sampath Vishwa app. They rolled out zero equity housing loans with real estate developers, opening home ownership financing to a segment previously locked out by upfront capital requirements. And they launched a green fixed deposit backed by a formal framework with independent assurance, sustainability, positioned as an actually funding product, not just a CSR line item. The timing is deliberate. This is a bank moving into growth just as economy shows a fragile but steady recovery, expanding ahead of the cycle rather than behind it. Higher risk but real first move advantage if the recovery holds through 2026. One more scope move worth flying. As a newly designated DC, the bank has announced plans for a fresh capital raising exercise, a bond issuance across 5 and 7 year tenors, with the first tranche expected to cover about half the total, specifically to reinforce its total capital adequacy ratio as it settles into its new systematic status. That's forward scoping for a regulatory requirement before it becomes a constraint. Zoom out level, Bank PL top four wholly owned subsidiaries: Sampath Finance, Sampath Securities, Sampath Information Technology Solutions, and Sampath Center. In January 2026, just after the reporting year closed, the bank moved to establish a new wealth management company currently awaiting regulatory approval. That's a textbook related diversification move, staying inside the financial services but extending the value chain from core lending and deposits into wealth advisory, typically a high fee income, low capital intensity business. It pairs naturally with the private banking push we just talked about. Execution discipline shows up in the numbers too. Total operating income grew 25.1%, well ahead of the 12% gross income growth, a sign that revenue mix, not just volume, is doing real work. And even after the extra DC buffer, the Tier 1 capital ratio sat at 14.75% and the total capital at 17.65%, both comfortably above regulatory minimum. Even though, worth being precise here, both ratios actually declined from 2024, 16.75% and 19.38% respectively, simply because the loan book grew so fast. That's a conclusion, not growth at all costs, but it's also the reason capital raise is now on the table. Strategy doesn't execute itself, and 2025 was a leadership transition year at Sampath. Ayodhya Idewala Pereira retired as managing director, and after what the bank described as a comprehensive evaluation process run by the board's nominations and governance committee, Sanjay Gunawardana was appointed the new MD and CEO, explicitly framed as continuity with the bank's succession planning framework, not a disruption. In his own words, he opened the first review by thanking his predecessor for a smooth transition in leadership. Chairman Harsh Amrasekar continues to set the tone at the top, with the board now operating through 12 subcommittees, including a sustainability committee, established back in 2024, reflecting the heavier oversight standard that comes with these standard status. The new CEO has also been explicit about where he wants to take the bank. He stated short-term goal, double-digit growth in advances and new ESG-linked loan products, medium-term, double-digit growth in SME and retail, a cost-to-income ratio below industry average, and a meaningful digital revenue contribution. Long-term, to be recognized as Sri Lanka's best bank across every customer segment, hit net zero in the bank's own operational footprint and consistently deliver above industry standard return on equity. That's a fairly bold marker to set in your first annual report as CEO. Worth watching where it holds. Now the scoreboard, straight from the bank's own financial snapshot for the year ended 31st of December 2025. Profit after tax 30.2 billion rupees, up from 10.6%, the highest in the bank's history. Gross income 218.8 billion, up by 12%. Earnings per share 25.76 rupees, up from 23.3 rupees. Return on equity 17.93%, marginally ahead of 17.74% the year before. Notable because it happened despite falling interest rates. Return on assets on after-tax basis actually is slightly from 1.66% to 1.6%, simply because the asset base grew faster than profit could keep pace with. Asset quality genuinely improved. The stage 3 impaired loan ratio fell from 4.69% to 3.31%, and Fitch Ratings affirmed the bank's national long-term rating as AA minus, a stable outlook. In September 2025, it's up from A the year before. That's real credit quality signal, not just talking point cheerleader. Operating expenses rose 18.9%, faster than gross income growth, largely tied to cost of standing up Evolve X itself. and both capital adequacy ratio and liquidity coverage ratios, while still comfortably above regulatory minimums, moved down year on year as the balance sheet expanded quickly. Rupee liquidity coverage fell from 340% to 280%, still miles above 120 regulatory floor, but a trend worth watching into 2026. The strengths are real. Record profitability, a genuine and sequenced digital and wealth strategy rather than a bolted innovation lab, a credit rating upgrade, and a share price that rose 23.9% over the year while still trading below book value with a modest price to earning ratio, which is on its face an attractive entry point in growth. This is all. The risk worth watching, capital and liquidity buffers are trending low, not up. Even though they remain compliant, that's exactly why a new capital raise is already being planned. None of these, none of that is a red flag on its own. It's simply what disciplined diligence looks like. That's Sampath Bank PLC, bank that took its DC designation as a validation rather than a burden, and it's now running a genuinely sequenced strategy. As always, this is analysis, not a buy or sell recommendation. I'm a host. Thanks for spending 15 minutes with my podcast. See you later.